At a new record, it's becoming a familiar line, isn't it? In trading this morning, gold futures hit $1,351 an ounce, and they have gained 22% year to date, and they more than doubled in less than 5 years. It is a raging bull market, a perfect time to bring in one of the world's best gold investors. Evy Hambro is joint CIO of BlackRock's Natural Resources Equity Team, and his $13 billion BlackRock World Mining Fund has outperformed 96% of its peers over the past month and over the past 5 years. Evy is with us from his London offices this morning. Evy, great to have you. Let's talk about central banks. As long as the Fed, the ECB, the Bank of Japan are printing money, it seems that gold has nowhere to go but up. Is that a bulletproof trade, or is there a point at which gold effectively becomes overvalued relative to the depreciating dollar?
Yeah, it's a very, very good question, and I think it's something we spend a lot of time thinking about. I think that the grounding point for gold and for all commodities is obviously the marginal cost of producing that commodity. And that's always going to be the margin for a producer is always going to be the telltale sign for when a commodity has gone too far above that. Today, with gold prices at around $1,300 an ounce or so, we are seeing a healthy level of profitability for established producers. But the returns that they can make from building new gold mines today remain relatively low. And so the average price required for breaking even on a new gold mine is in excess of $900 an ounce. And I think with some of the cost inflation we're seeing in the mining industry, that number's probably on the rise. And so I think that's a good reference point to see whether the gold prices have gone too far. At $1,300 an ounce, your after-tax rate of return on a new gold mine investment today is not going to be one of these returns that's going to be exceptional.
Okay, so then, you know, you just made reference to $1,300 an ounce and the constraints on profitability. On the supply side, it's something that so many people forget. So when you do consider those factors, the need for new mines to be profitable, is there a point in the intermediate term that you can forecast the gold price?
Yeah, I mean, we always look at supply and demand for gold, and you have to look at the supply side to start off with. Supply of gold from the mining industry peaked in 2001, and as yet has been unable to get back to that same level of production, despite the gold price having risen in that same time period from $250 an ounce to $1,300 an ounce today. And that rise in price hasn't encouraged new supply to come online. Exploration success has been limited. The cost of finding new gold has gone up hugely during that time period. With regards to central banks, historically they've been large suppliers of gold to the market. For over 2 decades now, they've been significant sellers of their gold reserve holdings. But in the last couple of years, central banks have turned from sellers to accumulators of gold for their reserves. So again, that's a shift in the supply and demand dynamics. And obviously, the major point has been the launch of the gold ETFs, which BlackRock is part of. With their IAU product, the gold ETFs have really opened up the market to gold investors who previously have had to go and buy gold coins or find more expensive ways to be exposed to gold.
Evy, that raises an important question that I'd like to get to before we only have about 45 seconds left. So many investors, John Paulson, George Soros, Erik Mindich, David Einhorn, they favor bullion over miners. You historically have liked the leverage that you get in gold miners. Are you turning your strategy more towards one that mirrors theirs, more bullion, effectively?
No. Yeah, no, we've always been an investor in gold equities in our products. The ETF product is an addition to is part of that range, and I think for investors, you should balance your exposure between the two. The equity products come with additional risk, whereas the underlying ETF product is backed by physical gold and has that characteristic.
Evy, we're running out of time. We'd love to have you back. Evy Hambro of BlackRock.